Good morning, everyone. Um, uh, Good to see you. Today, we are going to begin our, second to last chapter, or our major chapter that is remaining for the semester on CVP, or cost volume profit analysis. Okay, just in terms of our Apple investment, I know as of Tuesday of this week, earlier this week, our stock was selling at approximately $122 and 66 cents per share. When I looked a moment ago at the market prices, a share of Apple stock was trading at approximately $123.04. So we're seeing a little bit of an uptick in that stock as of this week, actually, and it's basically primarily because of the fact that people are anticipating that there's going to be a stimulus package, which is going to be offered by the government again, and also with the advent of the vaccines against the coronavirus epidemic that we are going through now. Some positive anticipation about start getting back to our normal lives a little bit. So we see that being reflected again in the markets overall. I do want to remind you that we are meeting today, obviously, and then we're going to be meeting next Tuesday and Thursday, okay? Thursday of next week is going to be primarily based on a review of the entire semester. Just not in total detail. You need to really start going over, remember, Chapter 12, when you started learning about Chapter 12 and discontinued operations. You've learned a lot this semester, okay? So it's time to start reviewing that slowly, and we're going to be moving forward. And then please remember that our final is going to be on December 15th from 11 a.m. to 1 p.m., and it's going to be on McGraw-Hill. All right, and again, most of the chapters that are going to appear on the final have you basically been tested on before through the 2 midterm exams. So really, the new information is just going to be these last few chapters that we've gone over. Now, Chapter 20 is a very important chapter. We're going to continue our review dealing with management accounting. Okay, and then we also have Chapter 14, but again, Chapter 14 is just, I'll give you an overview of it. All you're really responsible for knowing is a couple of ratios and just some background information about classified balance sheets. And what that is basically is dealing with how information is presented on the balance sheet, the different ways that companies, publicly traded companies, can decide to present this information. Okay, all right. So if there are no questions at this point, then we're going to continue with CVP analysis. Okay, and when we talk about CVP analysis, it stands for cost volume profit analysis. And again, it is still dealing with management accounting. And I want you to realize that even if you are not planning on going into the accounting field, if you're going to be in the management position of a company, this type of analysis is really important and very, very useful to you, okay? Okay, and Joshua, one topic. No, it's going to be equally weighted. Joshua, the whole, all the chapters we reviewed, it'll be equally weighted, okay? And there'll be, on the final, there'll be 50 multiple choice questions in total. That's a departmental requirement, okay? And I'll give you an overview, like where to focus, because I know it's so much information on Thursday. I will give you somewhat of an overview on where to focus more of your time. Okay? All right. So when we're talking about cost volume profit analysis, what are we trying to do? Basically, what's happening is that management is looking, okay, at the operations. They're looking at the financial statements. Okay, and also the production reports, the management reports that they receive, and they're trying to see how costs behave. Okay, so we know that in the last chapter, basically when we were dealing with product costs, we were focusing more on where the actual costs are incurred. That is, are they incurred in the factory setting, where those costs then would be considered product costs, versus general and administrative costs if they are basically incurred in the administrative area. This chapter, we're not looking at where the cost is incurred. We're going to be looking at how the cost behaves. Okay, so I'm just going to pull up a blank slide here so we could just go over a little bit. Now, you remember when you were all in Accounting 101, when you were baby accountants, you know that when you looked at the income statement, okay, the first income statement that you learned was a basic income statement, okay, and basically it began with revenues. Okay, and then we know that after the revenues, okay, in the basic income statement, we would just subtract expenses, and that's all expenses incurred by the company. Okay, we would deduct expenses, and then after the expenses were deducted from the expenses were deducted from the revenues, that is when we would arrive at the net income. Okay, and that's basically what you use throughout accounting, or the majority of your Accounting 101 studies. The basic income statement and revenues and expenses would just group together that way. Now, okay, when we were dealing with the income statement of a merchandiser, okay, when you were dealing with, again, you always started with revenues, right? That's always the starting point. Okay, and then after revenues, okay, what happened here was now for a merchandiser, you basically subtracted the cost of goods sold, right? You subtracted the cost of goods sold, and that's basically the cost of the inventory that was transferred from the inventory to your customers. Okay, so the cost of goods sold was deducted from the total revenues. And then after that, you arrived at your, who remembers, the income statement for a merchandiser. What do you arrive at? Excellent, Danielle, gross profit. So then now you arrived at gross profit. Okay, then once you arrive at your gross profit, now you know, and again, those are all the product costs, right? The cost of goods sold is made up of the product cost of direct labor, direct materials, and manufacturing overhead for the inventory that has been sold. Okay, and then, I'm sorry, this is for a manufacturer. I mean, let me go back. This is actually for a manufacturer. Okay, I'll cross that out. Actually, you know what, for a merchandiser also, I'll extend that definition. This is for a merchandiser and a manufacturer, right? Because both of them deal with cost of goods sold. So then once you arrive at the gross profit, after that, from the gross profit, you're now going to subtract all selling and administrative costs. Okay, so you subtract the selling and administrative cost, and then finally at that point, you are then, after you subtract that, and after you subtract the cost, first the cost of goods sold to arrive at your gross profit, then the selling and administrative expenses, that is when you're finally going to arrive at your net income. Okay, now what I want you to realize, okay, is that when we're talking about net income, the net income that we arrive at here in the basic income statement and the net income that we arrive at here, really that's the same net income that both of these different companies are arriving at. It's just the way they are dividing the expenses, okay, is different. All right, and again, it's for informational purposes so that the manufacturer or the merchandiser can get more information here from the gross profit. What is it going to give us? The gross profit tells us how much profit has been made just from the sale of the inventory. Okay, so here we're dividing the expenses a little differently, but the bottom line is the same. Okay, so I just want you to realize that. And now in this chapter, okay, in this chapter, we are going to look at CVP analysis, or cost volume profit analysis. Okay, and we're going to see that the income statement that we deal with here cost volume profit, sorry, cost volume profit analysis, the income statement that we use here is also set up a little differently. Okay, so again, the revenues part is the same, and the revenues typically are going to be from sales, right? However, when we look at CVP analysis, we are going to divide the expenses based on how they behave. Okay, remember here when we looked at the income statement for a manufacturer or for a merchandiser, we divided costs based on where they were incurred, right? Any costs incurred basically in the factory were deducted and included in the cost of goods sold. And then any administrative costs or period costs were subtracted later on in the income statement below here from gross profit. Okay, now when we're dealing with the cost volume profit income statement, the first thing we're going to do again is start with revenues. Okay, then what we do after that, we are going to subtract costs based on how they behave. Okay, so from the first expense that is going to be deducted from the revenues are all the variable costs. Okay, so variable costs are deducted first, okay, when we are dealing with CVP analysis. And after all the variable costs are deducted, we are going to arrive at the contribution margin. Okay, and the contribution margin, basically the way, the reason that the income statement is presented this way is because the contribution margin basically is going to tell any of the managers who are looking at this income statement, it's going to tell them how much revenue has the company basically generated, okay, from its sales that is going to cover its fixed costs and any profit that it generates. Okay, so the contribution margin basically contributes to the fixed cost and to any net income that exists. Okay, so first we start with revenues, we subtract out the total variable costs, then we arrive at the contribution margin. Okay, then after we arrive at the contribution margin, at this point we are now going to subtract any fixed costs. Okay, then after the fixed costs have been deducted from the contribution margin, at that point, we are then going to arrive at the net income. I'm sorry, and in this instance, we are going to arrive at the operating income. Okay, so when we're talking about CVP analysis, we're not going to be dealing with net income per se. We are going to be discussing operating income. Okay, and the difference between net income and operating income is basically operating income is net of any is prior to any income tax deduction. Okay, so operating income basically represents income before income taxes. Okay, because since income taxes are not really considered a variable cost or a fixed cost of the corporation, it's not a result of its operations, it's really external. Okay, when we do CVP analysis, we do not consider the effect of the income taxes, so we're always going to be dealing with operating income. Okay, so a little different there. Okay, but again, it's the same basic principle. Okay, we're trying to look at costs and analyze our costs based on, when we're doing CVP analysis, we're analyzing these costs based on how they behave. Okay, variable costs, okay, behave differently than fixed costs. All right, so here we're going to be dividing, or we're going to be separating them differently when we look at the income statement. Okay, remember that when our income statement for a manufacturer or for a merchandiser, we also changed the format of the income statement a little bit. Here we deducted the cost of goods sold first, Then we deducted the selling and administrative costs. The income statement for a merchandiser basically separates costs based on where they're incurred. So I'll write that here. When we look at the income statement for a merchandiser or any manufacturer, here the expenses are separated based on where they are incurred. Okay, and that is, were these expenses basically incurred in the factory setting, or were they incurred in an administrative setting? Here, when we look at CVP analysis, we are going to separate expenses based on their behavior. Okay, and now, of course, you can assume that based on these differences, since the information on the income statement really appears differently and is analyzed differently, you can assume that the information that you're going to need, right, from your management reports has to be established differently also. It has to be presented differently as well. Okay, so you, again, as a manager, as a senior executive in the company, you have to ensure that based on the type of analysis you're doing, you're going to have access to the appropriate income statement. Okay. All right, so now when we do CVP analysis, Joshua, can you explain what you mean? Exactly. Yes, I will. Joshua, I'm getting to that right now. Okay, so when we talk about cost behaviors, okay, what are some of the different costs that we're going to be looking at when we do CVP analysis? Okay, so now what we're going to be focusing on for this chapter is 3 different types of costs. Okay, and these 3 costs each behave differently, and I'll show you now, I'll explain to you what I mean by that. The first type of cost that we're going to be looking at for CVP analysis are fixed costs. Okay, now when we talk about fixed costs, what you've basically learned in your accounting studies is that fixed costs basically remain the same, okay, or do not change regardless of the volume changes. Okay, and that basically means no matter how many units I produce, okay, or how many units this particular manufacturer produces, you know that the fixed costs basically are going to remain the same. Okay, what are some examples of fixed costs that we've come across? Okay, what are some of the examples of fixed costs that we've talked about in this class? Rent, excellent, Christian, that's the first one. We know rent is a fixed cost. We know depreciation expense. Salaries, okay, they're a fixed cost as well. Okay, these are all fixed costs and they don't change based on the volume of activity. Utilities, we're going to talk about, Joshua, utilities in a moment, okay, because utilities actually are a different type of cost, and I'll show you that in a moment. Okay, but insurance, yes, Christian, that's a flat fee. It doesn't matter. You're going to pay that fixed amount. And again, a fixed cost, okay, even if there's a labor strike, okay, even if there's a labor strike and not one unit is produced, right, you know that if you're basically, if you own a factory, or if you're renting a factory, you still have to pay for the rent. If you own the factory, you still are going to deduct depreciation expense. And you also, as long as you're paying your employees, management, if you're paying their salaries, you still have to pay the salaries. So all of those expenses would be considered fixed costs. Okay, they are independent of the volume of activity that basically is being incurred. Okay, that's basically occurring. Okay, now, and again, we're going to spend a lot of time talking about these. I just want to introduce these costs here. Okay, the second type of cost that you've learned about this semester are another type of costs which are called variable costs. Okay, now you know variable costs basically change, okay, in proportion. They change in proportion to the changes in the activity level. Activity, or even a better word is production level. So you know that if it's a variable cost, the more units that I produce, okay, the higher the variable costs are going to be. Okay, now some examples of variable costs would be, what would you think? Supplies, I guess, yeah, if you're talking about, all right, to a certain extent, yes, okay, supplies, I'll take that. What else? Yes, fuel, that's something we're going to come across in our example. Very good. Fuel, if you're an airline. Direct labor, that's a biggie. Yes, Joshua, direct labor. Very good. Direct labor. Commissions, okay? Commissions would be, yes, because their commissions are paid usually as a percentage. So the greater the activity, let's say sales commissions, then yes, the greater the sales commissions would be. And then Christian, are cost of goods sold and variable costs considered different from each other? Yes. So Christian, here we talked about cost of goods sold when we were dealing with like the income statement and the balance sheet of a manufacturer or merchandiser. Now, when we're dealing with CVP analysis, remember we're talking exclusively management reporting. Okay, so here when we're talking about management accounting reports, that's why we're not really looking at cost of goods sold. We're dividing that cost a little differently. So for the cost of goods sold, any of the variable costs like direct materials, direct labor, any variable manufacturing overhead, that's going to be deducted from the top part of the income statement, and any cost of goods sold that are fixed in nature. Okay, so let's say it would be like the factory depreciation, also administrative office depreciation, things of that nature. The way those costs are now going to be reviewed when we're doing CVP analysis, it's just that you're dividing, you're no longer thinking inventory versus cost of goods sold or the selling and administrative offices. Here, you're just looking at how do those costs behave. Okay, are those costs variable in nature? That is, they change based on the amount of production that we do, or are they fixed in nature, meaning that they're not going to change? They basically are a stated amount and they don't change regardless of the production that is undergone. So we're dividing that cost of goods sold a little bit differently based on how the costs basically are behave. Does that make sense? Okay, very good. So when you're dealing with these three different income statements, you have to think, okay, what's the goal here? Okay, and then here for CVP, it's very different, and we're only looking at, and the reason why do we care? Why are we so interested in the way costs behave? Because here, the whole assumption for CVP analysis is that if you understand how costs behave, you're better able to control them. Okay, and that's the difference here. We're running the operations. We're really at a production level. So we want to be able to understand how our costs behave, because then, and we're going to see the type of analysis that you can do when you set up your income statement this way, when you set up your management reports this way. It really helps you really run your operations more in detail. And that's why we have we have to revise our income statement a little bit. So based on what you want to do, you're going to set up your management reports a little differently. Okay, and yes, Joshua, raw materials, very good. So here, when we're talking about the pure variable costs that basically fluctuate in direct correlation with production, we're talking about supplies, fuel, direct labor, and direct materials. Those are the biggies. Okay, so again, this income statement is only used for CVP analysis. All right, and now we're going to introduce, okay, a third type of cost that we look at when we're doing CVP analysis, and that is called the semi-variable cost. Okay, and this is why, Joshua, this is why I told you I'm going to hold on to your example of utilities. When we're looking at semi-variable costs have both fixed cost element and a variable cost element within the same cost. And the example that comes to mind typically is utilities, the example that you used. Okay, because if you look at an electric bill, you know that typically what happens is on your electric bill, you're going to see a flat fee. Okay, for you basically to have access to the electrical wires and the currency, everything, the electric currency that the utility is providing, there's a flat fee. Even if you go on vacation for a month, okay, you still have to pay that flat fee to Con Edison or whoever, okay, because of the fact that you had access to their electric supply services. Okay, that's the fixed element of it. Okay, then in addition, okay, the utility is also going to charge you a variable cost, okay, based on your usage. Okay, you know that if you use more electricity, typically, let's say during the summer months, because you have your air conditioning on, you know that typically your utility bill is going to be higher because your usage is higher. Again, but the important thing to remember here for a semi-variable cost, it has both a fixed element and a variable element. Okay, so typically here we're dealing with utilities. Okay, what else do all of you guys use? What else are you attached to that you have a semi-variable cost associated with? You guys are attached to it. Exactly, a cell phone. The cell phones also, basically your cell phone, you have a connectivity charge, right, for having access. Yes, very good. Cell phone and the phone service. If any of you have landlines, I know you probably don't even know what a landline is, some of you, but if you have your phone, stationary phone at home, you also have, that's also a semi-variable cost. All right, so when we're looking at the type of cost in CVP analysis, we're going to have to figure out, okay, what are the fixed costs, what are the variable costs, and what are the semi-variable costs. Okay, so these are the type of things that we are going to be analyzing, okay, over the rest of this particular chapter. Okay. So just realize, and again, remember that it's operating income, which is the income before taxes, when we're doing CVP analysis. Okay, everybody good? All right, and this is a fun chapter because all of you are going to do CVP analysis at some times in your careers or in your personal lives when you're analyzing different choices for assets that you may be purchasing. Here, let me just get to this slide and then I'll see your question. All right. Oh, could you, Dante, so could you say salaries are variable if people's, they could be, but again, Dante, and I want to make this a point, don't overthink it. Yes. Okay. So for our purposes, salaries could be variable if somebody gets like a raise or even if somebody new is hired. But again, it's always anticipated that for that time period and for future periods, it will be a fixed rate. So that's why it's considered that's why it's considered a fixed cost. And here really salaries are considered a fixed cost because wages are considered a variable cost, right? Because the wages basically are on an hourly basis or on a per unit basis. So that's really the distinction that we're drawing between wages and salaries, where wages are based on the hourly activity. So that's considered a variable cost, while a salary is a fixed amount. So in that sense, salaries would be considered a fixed cost. Okay. All right. So, all right. So let's continue with CVP analysis. All right. So why in the world do I care? Okay. Why do I want to do this type of analysis and really look at the changes in the costs of my operation? Okay, one of the most important pieces of information that a manager, that a CEO, CFO wants to know is what the break-even point is. And we're going to be talking about break-even point here a lot. All right, when we're talking about break-even, okay, that is basically the point where total revenues equal total expenses. That's always going to be a starting point in our analysis, the break-even point. Okay, because when total revenues equal total expenses, okay, that means the company is not generating a profit. Okay, but it's just breaking even, it's just covering its operations right now. Okay, so what happens if they sell one more unit above the break-even point? What gets generated if a company sells one more unit above the break-even point? Profit. Excellent. They're going to be generating profit. Excellent, Rachel Christian. Okay, again, what happens if they basically sell one unit below the break-even point? Okay, you know the company is going to be operating, excellent, Joshua, at a loss. Okay, so the break-even point is really going to be one of our starting points in our analysis of CVP. And then we could see all the different types of information that we're going to be able to generate from using that basic equation. Okay, again, what else can we tell with CVP? How many units we have to sell. Okay, so once we know what our break-even point is, how many units we have to produce and sell to arrive at break-even, then we can say, then we can start analysis, okay, how many units are we going to have to sell then to earn a specific operating income? That is, if I want to have, and again, remember, operating income for CVP, not net income. If I want to arrive at a specific amount of operating income, let's say $10,000, okay, how many units will I have to sell then in order to generate an operating profit of $10,000 or any operating profit that I wish? Okay, and we're going to see that again as we go through the chapter, how managers and different executives of the companies or managers in the company basically determine what they want to produce and what their desired income is. Okay, again, these things don't happen arbitrarily. Okay, you have to have budgets, you have to have standards, you have to have goals. That's the only way you can stay competitive and stay in business. Okay, so that's why CVP analysis is so important. Okay, a company also uses CVP analysis really to look at what happens if we expand capacity. What if we want to basically increase the level of production and sales significantly, okay, of our corporation, but that means we have to add on to our factory. Okay, again, if we add on to our factory, okay, what type of costs are going to be affected there? Most likely. Okay, what type of cost that we were talking about if we're adding on to our factory? Is it going to be a variable cost or fixed cost? Okay, if we're looking to expand, it's going to be fixed cost, right? Because if we're adding on to our factory, whatever cost we have, we're going to have to then depreciate that, okay, depreciation expense. So if we're looking to expand capacity, that is going to be a change in our fixed costs. Okay, so we have to make sure that, okay, what level of sales, if you change one part of the equation, you're going to have a change in another part of the profit equation also. Because if you change your fixed cost to get a certain amount of net of operating revenue, remember the amount of your operating income, the amount of your revenue has to change as well. Okay, so for this chapter, we're really going to be looking at how costs behave. Okay, again, and this is something that happens, the differences if we change the compensation, let's say, for our employees. Okay, what if we're looking at our salespeople? Right now, we're paying them based on a fixed salary. Okay, but you know what? We want to motivate our salespeople a little more. Okay, we want them to get a little bit more hungry and to be a little bit more competitive. So what are we going to do? We're going to change a portion of their salary schedule. We're not going to make it fixed. We're now going to change a portion of their salary and make it now a variable cost. Okay, so here, if we're looking at changing the salesperson, our fixed cost recurring expenses, for the most part, yes, they're going to be a monthly expense or an annual. It could be an annual expense either also. Okay, but typically, remember, with accrual accounting, when we recognize fixed costs, we're going to be dividing them when we do our adjusting journal entries at the end of the month. Typically, they're going to be divided on a monthly basis. So they are a recurring expense for the most part, yes. Okay, so again, just to get back to when we're changing our employees' compensation packages here, what are we doing? We're changing a fixed cost or a portion of the fixed cost to a variable cost. Okay, so that's going to have that's going to change again our CVP analysis, right? Because we were deducting, considering it a fixed cost. Okay, now we're transferring some of that fixed cost to a variable cost. All right, so again, all of these type of changes, these are the things that you're going to be able to analyze. Okay, and again, you would do that. Why would you change your salespeople from a fixed basis to a variable basis? To try to incent them a little more, give them more incentive. Okay, and also to try to increase the amount of your sales as well. Okay, so what if you expand capacity? Can you please explain why it's a fixed cost if it doesn't have? Okay, so what happens if we expand? Okay, so again, we're looking at fixed costs and how they behave. If I invest, let's say $1 million, okay, in enhancements, if I expand my manufacturing operations, the actual factory, if I invested an additional $1 million, okay, so I have a cash outflow of that amount of money. What am I going to do with that $1 million addition? Okay, what has to happen with that $1 million addition over the life of that asset? What am I going to do? I'm going to depreciate it, right? That's how the cost of that addition is going to be basically expensed over its useful life. So that's why if you could expand capacity, how is it going to appear on your income statement? It's going to appear as depreciation expense, which is a fixed cost every month. Okay, good. All right. Okay, you're welcome. All right. So those are just some examples of what you're going to be able to do once you understand CVP analysis. Okay, so for our example, all right, and we're going to be looking at this in detail. For our example, we're going to be looking at a particular operation, which is an airport operation, just for analysis purposes. So here we're looking at McKinley Airlines, which is a small airline charter service based in Alaska. Now, here we're going to be told the average monthly cost of operating the airline is $66,000. And again, this is average cost. Okay, that doesn't mean every month it's $66,000. It's basically, you know, averaged together over an annual period. Okay, so we're still going to go back. Remember when we were dealing with manufacturing overhead? How do we apply manufacturing overhead? We used a cost driver, okay? When we're looking at an airline operation, a typical cost driver, and again, this is basically the way that variable costs are going to be applied to production. Okay, typically the appropriate cost driver for airline is going to be airline miles or passenger miles. Okay, so when we're looking at this particular airline, we're going to use passenger miles as a cost driver. And basically what happens as the number of passenger miles increases over the year, the amount of variable costs, such as fuel costs, wages paid to the airline attendants, all of those you would expect to see increasing as well. Okay, and then now we're going to be looking at this airline, and we're going to be looking at the different type of expenses based on this new the new definitions that we learned, such as the fixed cost, the variable costs, and also the semi-variable costs. Okay. All right, so the first type of cost, we're going to start very basic, okay? The first type of cost that we've been talking about in accounting, and we're really going to focus on now in this chapter, are fixed costs. Okay, so fixed costs are those costs and expenses that do not change significantly in response to an. Okay, so again, Joshua, this goes back to what you were asking earlier. Why is depreciation a fixed cost? Here, you know that an airline, typically, if they have to have an airline hangar, they have to have, let's say, a runway or whatever basically they utilize in the airport. You know, for when you have a large amount of fixed assets, depreciation expense would be a large fixed cost. Okay, and you know why is it considered a fixed cost? Because it does not vary based on the amount of passenger miles flown. Okay, and again, if you have a labor strike, let's say the worst case example for an airline, if you have a labor strike, do you still have to deduct depreciation expense on your financial statements for that month? And the answer is yes. Okay, because you basically have to recognize that expense regardless of whatever your revenues are. Okay, and again, depending on the type of business, okay, and you would always be told basically if, you know, you would be given hints as to whether a cost is a fixed cost or a variable cost, but some other expenses that you can expect are going to be considered fixed costs, or things like administrative and executive salaries, like the CFO salaries, the CEO's salaries. As soon as you see salaries, you assume it's a fixed amount, okay, that you recognize on a monthly and annual basis. Other fixed costs would be property taxes, okay, rents that you have to pay, okay, leases, okay, if you're leasing or renting your operations, and also insurance. Okay, so all of those are examples of fixed costs. Okay, because remember, in CVP analysis, we're looking at the behavior of cost more. So the definition becomes very important. Okay, so if I were looking at a graph, okay, if I were looking at a graph of fixed costs in total, okay, so this is looking at fixed costs in total, okay, and here I have the activity, okay, so let's say here the activity is passenger miles for this airline, okay, and here on the x-axis, that's X, yeah. The x-axis is basically the different activity levels or passenger miles flown, and on the y-axis I have the total costs. Okay, the total fixed costs. If I were graphing the total fixed costs, okay, on a graph, what would the total fixed cost look like? The graph of total fixed cost. What would it look like? Excellent, Christian. Just a horizontal line across. Okay, and we're going to talk about this a little more, but it's always basically a horizontal line over within the relevant range. Okay, within a certain range of activity, which is like about 80%. Again, we're not looking at extreme levels of activity here, but within the relevant range, you know that typically the graph of total fixed costs are going to be a flat horizontal line. Very good. Okay, but okay, and this might take a little while to get used to. Let's look at the graph. Okay, again, this is now again of fixed costs, okay, but this is now on a per unit basis, okay, or here it would be per passenger mile. Okay, so let's say here, I think for this particular example, I think the amount of fixed costs was here, I'm just approximating it, is $37,500. So to run this airline, the amount of fixed cost equals $37,500. Those are all of the fixed costs. Okay, but now what happens? Okay, what happens to fixed costs on a per unit basis? Okay, as the number of passenger mile increases. If I look at fixed costs on a per unit basis, okay, here this was on a total basis, but if I look at fixed costs on a per unit basis, what does that line look like? That line looks like this, a downward sloping line. Okay, and what does that mean? That means that as I fly more passenger miles, okay, as I fly more passenger miles, what happens to the amount of depreciation expense per mile that I travel? The amount is going to decrease. Excellent, Lysander. Okay, and that's basically because it's a fixed cost, but if I'm applying it to more units, more passenger miles, the amount of fixed cost that every passenger mile has to basically absorb is going to be less. Okay, and this is basically why we divide the costs differently on the income statement for CVP analysis. Okay, because depending on how we analyze the underlying costs, okay, its actual behavior is going to be different than the way we thought of it previously. Okay? All right, so we're still looking at fixed cost. Okay, the first type of cost is a fixed cost. In total, we're used to dealing with it on a flat basis like this, a flat line. It's $37,500. Okay, for this airline, that's the amount of fixed cost. Okay, and then here, as the on a total basis, regardless of how much the activity is, we know it's going to be flat. Okay, but if we start analyzing the fixed cost on a per unit basis, we see that on a per unit basis, the actual amount of fixed cost is going to decrease as the activity amount increases. Okay, so that's how you can basically lower the cost of your product, okay, lower the expense related to your product when you're increasing the amount of your productivity. All right, and I just want to introduce it here. We're going to deal with that more in the future, but I just want to introduce it here. Okay, so the way you look at cost is going to be different, okay, when you understand how the cost actually behave on a in total basis versus on a per unit basis. Okay, good. All right. The second type of cost that we have been talking about and we're going to focus on for this chapter are variable costs. Okay, now typically we know when we've dealt with variable costs in the past, we know there's a correlation, okay, or a variable cost is one that rises or falls in approximate proportion to a change in activity base. Okay, and here, one thing that was brought up earlier, McKinley's fuel expense is an example of a variable cost, because the more passenger miles that the airline flies, the more its fuel expense is going to be. Okay, so if we look at variable costs in total, okay, if we look at variable costs in total, okay, what is that graph going to look like? Okay, and this we know in total based on the activity level on the x-axis and the cost on the y-axis. We know that typically the graph of the variable cost in total is going to be an upward sloping line. Okay, and again, we would anticipate if total passenger miles were to increase by 10%, we'd expect to see a similar increase in the fuel expense, right? Because you have to incur more fuel expenses if you fly more passenger miles. Okay, now that's the way we're used to looking at a variable cost. But again, if we look at a variable cost on a per unit basis, okay, if we look at the variable cost on a per unit basis, okay, we know that we basically, let's say we pay $1, okay, let's say we pay $1 for fuel expense, okay, per passenger mile, okay. We know that then on a per unit basis, if it's the activity level, if the activity level is on the x-axis, what would the line, okay, of the fuel cost be on a per unit basis? What would the graph of the line of the variable cost? How much does the variable cost change, okay, on a per unit basis, okay, or on a per passenger mile basis? We know that it looks more like the fixed cost line, okay, because within the relevant range. Okay, within the relevant range, we are going to pay $1, okay, per gallon of fuel that we use, regardless of our activity level. So on a per unit basis, the graph of a variable cost is just going to be a flat line like this. Okay. All right, just again, we're analyzing, again, we're focusing on this chapter, we're focusing on the way that costs behave, because once we know how costs behave, we are able to control those costs better. Okay, so here we know we're going to pay $1, okay, per gallon of gas that we purchase. We know that it doesn't matter on our level of activity, that is going to be the cost to us for our fuel. So what does the graph of our fuel cost look like? It looks like a flat line, okay, on a per unit basis. But how does it look on in total? It's going to be that upward sloping line. Okay, and we're going to see in a little while, once we understand how costs basically are incurred, we're going to be able to control those costs better. Okay, everybody good? Any questions? Okay, let's continue then. Okay, now remember the third type of cost I said we're going to be analyzing in this chapter? It's a semi-variable cost, like the utilities, like your telephone. Okay, what does the graph of a semi-variable cost look like? Okay, remember a semi-variable cost, another word name for it is a mixed cost, and it contains both a variable and a fixed cost element. Okay, so here, for this airline, McKinley pays Fairbanks Airport, so they're renting from the airport, they're renting a certain space, okay, and their rental fee is a semi-variable cost because it has a fixed rate to it, and they also are going to be charged for each passenger mile flown, okay? So the fixed portion of that leasing expense, okay, that's going to look like this, because this is on an in total basis. So what does a semi-variable cost in total look like? Okay, there is a fixed component to it, right? Because they have to pay a fixed amount, but then also it has that variable component. So the graph of a semi-variable cost is going to look like this. Okay, it has a fixed portion, and then it would have a variable portion on top of that. Okay, and always remember the variable portion starts where the fixed portion ends. Okay, so it's in addition. Okay, so again, the fixed part of the semi-variable cost for the airport is going to be the rent expense, or the leasing expense of the hangar, and then the variable portion is they charge them in addition based on each passenger mile that they fly. All right, so here these graphs are going to afford us really an understanding of how the costs behave. All right. Yeah, that's what it would look like. There would be two lines, yes. Okay, because you'd want to know what the fixed cost component is, Lysander, and then also what the variable component is, yes. Okay, you're welcome. Don't worry about that. And okay, so now we're going to apply our analysis. We're going to look at McKinley Airlines. Okay, so this is all stuff that you're already familiar with, okay? Here, we're going to be given different types of costs. And here, we're told what the fixed costs are. So you know, whenever you see per month a flat fee like this, you know that the insurance, you know the depreciation, and you know the salaries, these are all going to be fixed amounts. Okay, because that's the amount you have to pay on a monthly basis, okay? Regardless of the number of passenger miles, this is the amount that you have to pay for these particular expenses, okay? Then we also talked about there's a variable expense also, and the variable expense here is going to be 8 cents per passenger mile, okay? So the airline has to pay 8 cents per passenger mile. That's their estimate for what their fuel costs are, fuel and maintenance costs are. Okay, so that's a purely variable cost. These are purely fixed costs. This is a purely variable cost, and then you have this semi-variable cost. And it will always be broken down like this for you. Okay, you'd have to be told. Okay, and then the semi-variable cost has this fixed cost component, which is $3,000. That's that leasing amount, that leasing fee that they have to pay on a monthly basis, regardless of whether they operate or not. And then they have this variable component, which is the 2 cents per passenger mile. Okay, so this is basically the cost structure for this airline. All right. Let's go back to our graphs again, because we're looking at how these costs behave. Okay, we see here that passenger miles flown, okay, and this is exactly what you use CVP analysis for. Okay, we're going to analyze the underlying cost, that is the variable cost and the fixed cost, okay, based on the number of passenger miles. So McKinley has an option. they can either fly 200,000 passenger miles or 400,000 passenger miles. They're analyzing now the cost related to those two different goals. Okay, of how much they're going to fly this year. Okay, but here you know that for fixed costs. Okay, regardless of how many passenger miles they fly, you know that fixed costs are not going to change. Okay, now where do we get that from? We got that from here. Okay, when we added all of our fixed costs, okay, we just took this and that equaled $39,000. Okay, so those are our fixed costs for the month. And we know that's typically going to be that flat, in total, it's going to be that flat horizontal line. Okay, now what are our variable costs? Okay, how do we plot what our variable costs are? All right, so here our variable costs are 8 cents per passenger mile. So what, again, we would expect to see the graph of variable cost, again, to be that upward sloping line. Okay, so if the company flew 200,000 passenger miles, what would their variable cost be? $16,000, because we took the 200,000 miles times the 6 cents per mile variable cost. Okay, then if the company flew 400,000 passenger miles, what would the amount of their variable cost be? Again, multiply it by the 8 cents, and you get a total variable cost of $32,000. Okay, so this is how CVP analysis is basically set up. It's set up, you could do it graphically or by formula. So here, just so you understand how these costs actually function, here we're doing it on a graphic basis. Okay, and again, you would expect, these are all, I think you've been exposed to this like in high school, like algebra and geometry, right? Some of these graphs. And then again, the third type of cost we're going to be talking about is semi-variable cost. Again, what does a semi-variable cost look like? Remember, it has that fixed cost component, and then it also has that variable component. Okay, so here we have for 200,000, if 200,000 passenger miles are flown, the amount of the semi-variable cost equals $7,000. If 400,000 passenger miles are flown, the semi-variable costs are going to equal $11,000. Okay, so that's the graph of how these three different costs, okay, those are the individual graphs of how those costs are going to look. And then here for CVP analysis, what are we going to do? We're just going to combine. We're going to plot those three independent graphs. We're going to plot it on one plane here. Okay, so here, this flat green line here represents all of the fixed costs. Okay, and that's what we saw here, the 39,000. That's going to show all of our fixed costs. Then the $11,000 that we have here. Okay, the $11,000, that's going to be a graph of the semi-variable costs here. Okay, the semi-variable costs here again appear, and they're going to be plotted above the fixed cost. The semi-variable costs appear basically start after all the fixed costs, and then we have here our variable cost. The top of the variable portion of the semi-variable cost, we have the purely variable costs. Okay, so what does this tell us? Okay, what does this graph tell us? It basically tells us that our total cost, okay, our total costs, if the airline flies 200,000 passenger miles, our total costs are going to equal $62,000. Okay, if the airline flies 300,000 passenger miles, it's going to have a total cost of $72,000 incurred. Okay, and again, this includes the fixed, semi-variable, and variable. And then finally, if the airline flies 400,000 passenger miles, it's going to incur costs of $82,000. Okay, and now think about it. If the managers of this company have the ability to graph this information, to understand this operation, it can then make projections as to how many passenger miles they basically want to fly in the coming period. Okay, they can anticipate, okay, so if these are our costs, we're going to compare it to the amount of revenues, okay, and that will then tell us what our operating income is going to be. Okay, again, managers, this isn't like a haphazard thing that they back into after the fact. It's always done prospectively. You have projections, because this is how you want to run a business. Okay, you always have to anticipate what your costs are going to be and also what your productivity is going to be. Are you going to fly 200,000, 300,000, or 400,000 passenger miles? Okay, because it's going to have an impact on your operating income. Okay, so if we wanted to look at how these three different costs, fixed, variable, and semi-variable cost, basically look, we could look at these graphs, okay, to understand how they function. All right, everybody good? All right, so let's just write down this information on a chart, okay? So here, and look what happens, okay? Pay close attention here. If we flew 200,000 miles versus 300,000 miles versus 400,000 miles, this is what all the related costs will look like. The variable cost per mile, again, that's 8 cents per mile, would be $16,000, because 200,000 times the 6 cents equals 16,000. We could also take the 300,000 miles times the 8 cents, $24,000 in variable cost. And the same thing for the 400,000 passenger miles. Okay, then we know the amount of our fixed cost, right? We were given this, and again, you have to be given this information. Okay, so the fixed cost, basically, we know within the relevant range is going to equal $39,000. The fixed costs are not going to change. They're just going to be fixed. So we're going to add that to each of the expense schedules, right, for the different passenger miles. Now we're going to add our third cost component. We have the variable, we have the fixed. Now we're going to add our semi-variable costs. Okay, so the semi-variable cost, again, 2 cents per passenger mile, so $4,000 in the variable portion of the semi-variable cost, $6,000, again, 2 cents times the 300,000. And then if we flew 400,000 passenger miles, what would we anticipate the variable portion of our semi-variable cost to be? Okay, and then again, and what are we doing? We're trying to figure out how many miles we want to fly in the coming year. Okay, it's all done. Remember, management accounting is not looking at the past. It's looking at that past information and applying it to the future. Okay, to determine what you want your operations to be. All right. Now here, again, we told this information, the fixed portion of the semi-variable cost is just going to be a flat $3,000 across the three different passenger miles. Okay, so here we have the total operating costs, just like we saw on the graph, remember, 62, 72, and 82,000 for the three different passenger limits that we're going to have. All right, look what happens though. Okay, look what happens to the cost per passenger mile. And here all I'm doing is taking the total cost and operating by the passenger miles, total passenger miles. If we flew 200,000 miles, what's our cost per passenger mile? 31 cents. Okay. If, however, the airline flew 300 passenger miles, what is the total cost per passenger mile? It's only going to be 24 cents. So interesting, what's happening? The cost per passenger mile is decreasing, okay, based on the more miles that we're actually going to fly. Okay, and now look what happens if we decide to fly 400,000 passenger miles. What's the cost per passenger mile? It falls even more. It falls to 20.5 cents. All right, so this is exactly what happens. This is why we undertake CVP analysis, because what happens once you look at the cost and how they're incurred and how they behave, you may come up with some surprising information. Okay, so look what happens here. The more airline miles we fly, what happens to the cost per mile? We see that the cost per mile changes about 10 cents per mile. okay, if we double from 200,000 to 400,000, the amount of miles we're covering. Okay, now why is that? Why do you think that is? Okay, what's happening here is this company, okay, because of the fact that what they're doing here when they're flying more passenger miles, so as more passenger miles are flown, as more passenger miles are flown, okay, what happens? They are recognizing something that is called economies of scale. Okay, and what basically happens when you're operating, when an economy of scale is being undertaken? What basically happens is that since this company has such large fixed costs, since an airline has such a high fixed costs, has such high fixed costs, when these costs are spread over more units, when these costs are spread over more units, these costs are spread over more units or over more passenger miles, the cost per unit decreases. The cost per unit decreases. Okay, and that's really important, okay? Since the airline has such a high amount of fixed cost, here, let's say it's $39,000 on a per monthly basis, plus the $3,000 for the fixed semi-variable cost. If they plan to fly more passenger miles, what happens? That huge chunk of fixed costs that they know that they have to incur, they're spreading that large fixed cost over more units. Okay, so what happens then? The cost in providing, those services to their customers is basically going to decrease. Okay, because they're recognizing an economy of scale. Okay, because they're dividing these high fixed costs over more units. All right, so that's something that's really significant for managers to know when they're operating in a business model like this. Okay, because of the fact that they can take advantage of the fact that they can have cost efficiencies if they fly more miles. Okay, that's why if you ever, I mean, again, this is in the past, with COVID and everything, let's refer to the world as pre-COVID, that if you've flown on an airline, let's say in past years, an airline very rarely wants to have an empty seat. That's why you have these discount brokerages where you can buy your seats cheaper from a travel agent. That typically everybody who's sitting on that plane is paying a different price for that ticket. Okay, depending on where they bought it, when they bought it. Why? Because the company wants to fly that flight. Because the more flights that it flies, the more revenues it's going to generate. Okay, but what constriction do they have? They don't want to have empty seats. Okay, so that's why, again, utilizing this model, okay, of recognizing an economy of scale, you want to increase the number of passenger miles, but of course you also want to assume that you want to fill all of those seats also. So you have the maximum revenues as well. Even if you have to deviate a little bit, you can't charge a full fare for everything, but you're going to have somebody sitting in that seat at least to get some revenues for that. Okay, so really interesting when you start to look at how costs behave. Okay, and when you're in internal management, and again, you don't have to be an accountant. You can be in charge of the production department, in front of in charge of the hangar operations. Okay, this is still information that you have to analyze. Okay, to basically run your operation. Okay, everybody good? Okay. All right, and again, this is what happens if we wanted to look at graphically. Okay, what happens to the cost per passenger mile? We saw here that, again, when the number of passenger miles flown when those costs were changing from 200,000 passenger miles to 300,000 to 400,000, what happened to the average cost per passenger mile? We saw that it decreased significantly. Okay, and why is it? Because the amount of fixed costs, okay, was basically reduced on a per unit basis. The amount of variable cost didn't change on a per unit basis. That remained the same, but it's this graph of the fixed cost. Remember the fixed cost when I graphed it for you? When you're looking at fixed costs on a per unit basis, what does that graph look like? When you're operating an economy of scale, it's going to be downward sloping. So that's what we see here. Okay, so that's why when you have a large amount, and typically there's only certain industries where you're going to be able to use an economy of scale, and basically that happens in industries where you have a large amount of fixed costs, such as an airline, an oil rigging company, right? When you have huge amounts of fixed costs, that's when you can take advantage of economies of scale. Okay, so again, this graph is a little bit tricky to understand, but this is basically what we have been discussing up until this point. The way that variable costs and fixed costs behave, okay? If we look at variable costs on here, if we look at variable costs on a per unit basis, what do the variable costs on a per unit basis look like? Remember, on a per unit basis, it's going to be a flat line. The variable cost per unit is going to remain the same, okay, regardless of the amount of the change in the production, okay? Regardless of the number of passenger miles, the variable cost per unit remains the same, okay? However, remember, if we looked at variable costs on in total, okay, what does the graph of variable costs in total look like? Anyone? If we're looking at the variable cost, if we're plotting the graph for variable costs in total, okay, very good, Christian. It's going to be upward sloping. Okay, if we have the activity here on the x-axis, and if we have the cost incurred on the y-axis, this is what it's going to look like. Okay, and that's the line that you're used to seeing. Very good, Joshua. Also, okay. So again, but now we're looking at this variable cost. Remember, they don't change within the relevant range. So the way that we're going to analyze them is going to be a little bit different as well. Okay, let's look at fixed cost on a per unit basis. Okay, what happens when the activity level, again, on a per unit basis, fixed costs, as we just saw. All right, what happens to the graph of fixed costs on a per unit basis? Okay, remember that the total fixed cost, if we have zero productivity, is going to start somewhere around here. I think it was the $39,000 for our example, the fixed cost. However, what happened when we produced more units or when we increased the passenger miles? We saw that the fixed cost on a per unit basis actually decreased. Okay, and that's when we saw the cost per passenger mile flown, we saw it decreasing, okay, when the amount of mileage actually increased. Okay, so that's a key cost that we're going to analyze, the fixed costs, okay, in that, and we're going to recognize an economy of scale when we see a large amount of fixed costs being dispersed over a larger number of passenger miles. Okay, and again, the fixed cost in total, that's what we're used to seeing, right? The graph of fixed costs in total. Again, we always assume that fixed costs look like this, right? Regardless of the activity level, okay, it is always going to be that flat horizontal line. And again, in total, it still is. Okay, but if we start looking at how those costs operate on a per unit basis, okay, we could see how when we're dealing in a competitive environment, if we start analyzing these costs a little differently, we're able to provide that service to our customers at a lower cost. Okay, and that's pivotal for staying alive. okay, for staying afloat in a very competitive global business. Okay. All right. I won't bother with that. All right. So again, just to reiterate here, when we talk about economies of scale, basically, and again, for those 23 of you who are here today, guaranteed it's going to be a question on the final. Okay, you tough guys always show up every class. What is an economy of scale? It refers to the reduction of the unit cost, just like we saw. Okay, the reduction in the unit cost by using the company's productive assets more efficiently. Okay, we still have the same number of airplanes, but it's just if we try to maximize the number of passenger miles flown, look what happens to our cost for providing that service to our customers. Over the long haul, it is going to, if we increase our productivity, that is going to decrease. We're able to decrease the cost to actually provide that service to our customers. Again, an economy of scale is only typically used, is only really you can only really undertake it when that industry has a high amount of fixed costs. Okay, so typically the industries where you're able to operate an economy of scale would be in the airlines industry because they have such a high amount of fixed costs. In airlines, here we see here in an auto manufacturer, okay, you know, all the machinery or everything that they have in their factories, all the equipment, auto manufacturers, sorry. So here, the auto manufacturer, the airlines, in the oil industry, you know, for like the rigging and all of that, they have such a high amount of fixed costs. Again, that if they increase the amount of productivity, it's going to decrease the amount of the cost that they deliver to their customer on a per unit basis. So let's take another example here. So here, where this plant, okay, this auto plant incurs monthly fixed cost, okay, of $8,400,000. That's a big nut to cover, right? That's a fixed cost. Even if they don't produce one car, that's the amount of fixed costs that have to be expensed on a monthly basis. Okay, but look what happens, okay? Look what happens when the level of production increases. So if the company produces 4,000 cars, what's the fixed cost then that has to be absorbed by every car? $2,100. Okay, that is the amount of fixed cost that has to be charged and absorbed by every car that they manufacture and sell. Okay, however, if you take that same cost and let's up the level of production now to 6,000 cars. Okay, what's the amount of fixed cost that has to be charged to each car? Only $1,400. Okay, and again, what if we, same cost, fixed cost, but $8,400? What if the level of production now, if we increase it to 7,000 cars? Okay, what's the amount of fixed cost that every unit has to absorb? Only $1,200. Okay, so you see here, these are significant operating efficiencies that a company can basically benefit from when it's maximizing their production. Okay, what's the problem here? Why don't they produce 10,000 cars? Okay, remember that here, one of the assumptions when we're doing CVP analysis is that anything that you produce, you are able to sell. Okay, so here, for when we're doing CVP analysis, the assumption is anything we produce, we are able to sell and at the price that we want. Okay, so here, the more we produce, the more we sell, and we could sell it at a lower price as well because the amount of cost that is charged each of these units of inventory is lesser, so we can sell them for a lesser value. But again, we always have to assume that we're actually, and you know that car dealers, typically that's something an issue that they run into, that they have to sell all of their inventory. And that's another variable. For our purposes, we're not going to think about it, but just something to keep in back of your mind. Here, it's not limitless. Okay, there is a certain ceiling that's put on that because you have to be able to sell anything you produce. Okay. But this again, this is what this is the result of an economies of scale. Those huge fixed costs are just being applied to more units produced. So therefore, they're able to, the cost per unit is going to be less. Okay. I mean that they can lower the price on those cars and again, stay more competitive as well. Again, the economies of scale, typically, okay, steel mills should. So what companies typically can operate in economies of scale? Airlines, as we saw, oil refineries, steel mills, right? Huge amount of fixed costs. And utility companies, okay? Again, they have those huge infrastructures that they have to basically maintain. All right, so most large companies can operate some type of economy of scale. Again, and that's what makes it sometimes harder, okay, for other competitors that are to enter into any of these industries. Okay, it's hard for any outside competitors to enter these industries. Why? Because there's such a huge amount of capital that has to be invested up front, right? If you want to basically be a new competitor in any of these industries, since the amount of the fixed cost that you have to basically undertake are so high, that's a barrier to entry. Okay, but again, again, within that industry, you're able to operate. If you're able to operate more efficiently, you're able to basically reap larger rewards because of the price. The price per unit can be decreased if the amount of productivity increases. So really interesting, you know, this is when accounting really gets to be interesting when you get to apply it to different industries and different different scenarios. Okay, and that's what you do with CVP analysis, regardless of what career. See, it's not unusual that you're going to have to do some type of cost, volume, profit analysis. Okay. Again, and here, this is a great example. You know, pre-COVID again. This is not, I don't know what's going to happen to this airline industry after COVID, but you know, many, even pre-COVID, a lot of the airlines were losing money, okay, because they had such a high cost, a fixed cost of operating their operations. But Southwest, this tiny little airline, is basically able to, even though it's small, it was very successful. And why? Because, but what Southwest does, even though it has a smaller fleet, okay, they're able to maximize their number of passenger miles. There are fewer planes, but they're able to spread those fixed costs for operating those planes and all of those fixed costs for the terminal fees. They're able to apply it to fewer miles. So that means that the amount, since their fixed costs are lower, they were able to start generating profits at a lower amount of passenger miles also. Okay, so that even though Southwest was an upstart, it is one of the most profitable airlines, okay, because of the fact that their profit margin is higher because their fixed costs are lower. Okay, they don't have that same nut to basically crack when in terms of all of their fixed costs because they are a smaller operation. Okay, so again, there are advantages to doing this. And again, since they're smaller, it's easier for them to keep all the seats full. Okay, there are fewer seats to fill, they have fewer fixed costs, so they can start generating a profit earlier. Okay, than some of those big airlines that are like these monoliths that have been operating for many years, and they have such high fixed costs associated with them. Okay, so it can, again, but this is more the exception than the rule. Okay, it is because it's still a lot of fixed costs that have to be absorbed by a new airline. Okay, some additional cost patterns. Okay, so what are different ways? So now we saw variable cost, we saw fixed cost, we saw the graph of variable costs, we saw the graph of fixed costs, and we saw the graph of semi-variable costs. Okay, another type of cost structure can exist is something that is called a step cost. Okay, and what is a step cost? The reason obviously that it's called a step cost is because it looks like a staircase. It looks like steps, right? So what happens in the step cost is basically a certain cost, okay, remains fixed. So let's say here, if we're producing between between 0 and 100 units, okay, let's say that our costs basically equal $1,000. Okay, but once we produce, okay, once we produce 1 unit more, that is, once we produce 101 units, what happens? We have to hire an additional supervisor. Okay, so once our production basically increases above 100, anywhere between 100 units and 200 units are being produced, what happens? We have to hire an additional supervisor. So what happens? There's a steep increase in that cost at that point. Okay, our cost increased to $2,000 in total. Okay, then again from 200 units to 300 units. Okay, once we basically start producing 201 units to 300 units, what happens? We have to hire another supervisor. So what happens at that point when we manufacture 201 units? Our cost increase now to $3,000 in total. Okay, so that's when basically a step cost, you see that in an environment where you have a big, where you have a swift turn up or a swift increase in total costs when a certain level of production or volume of output is reached. Okay, or can it be like the smallest unit of direct material sold would be enough, 400 units, or would be, all right, so could you apply this to, here I'm looking at volume of output and I'm looking at the labor cost. Okay, so can you apply to materials too? Not really, because remember, typically materials don't have to be bought in huge, unless you have to buy it for some reason. If you have to buy them in big lots, okay, so you have to buy, if you could buy enough material for 0 to 100 units, okay, then, and then if you produce 101 units, then you have to then buy for, if you have to buy in bulk for some reason, you could possibly apply this to materials as well. Okay, but typically here I'm thinking more of like labor or something like that. Okay, but if Rachel, you could do it that way too. Yes. Okay, if you're buying in bulk. Okay. But this is what basically, Rachel, good question. Here, basically, when we're dealing with step cost, the thing to remember is that the costs remain fixed for a certain output, but then once you reach a certain point of output, there's a steep increase, okay, in the related cost at that point of production. Okay, and then again, once you reach that point, you have the increase in costs. It remains flat for a period of time, and then once you arrive at the next volume, then you're going to see a steep increase in that cost again. Okay, so it's mainly the behavior, okay, of that cost. Okay, and then here, remember that typically when we're dealing with when we're looking at graphs, okay, when we're comparing the volume of output to costs, like if this were a graph of variable cost. Again, remember I had been saying it's always a straight line. Okay, it's not supposed to be straight. It doesn't really look like it, but here, let me erase that. Okay, remember I'm saying it's a straight line, but remember that it's rare when you're going to have a perfectly straight line. Typically, when we're dealing with output and cost, you're going to see a line that's somewhat curvilinear, right? That's going to be somewhat curved. But remember that whenever we're doing CVP analysis, and this is important, whenever we're doing CVP analysis, cost volume profit, we're not looking at extreme levels of activity. We're not looking at the lowest points of output, and we're not looking at the highest points of output. Okay, because remember, if we're dealing with the lowest points of output, like if there's a labor strike or something, remember we really can't we can't analyze volume at that point. Okay, remember if we're looking at extreme levels of activity, okay, or really high levels of output, remember we have issues that come up such as overtime. We also have increased accident rates, things of that nature. So when we're doing our analysis of CVP, We're just looking within a certain range of activity, and that level of activity that we're analyzing is called the relevant range of activity. Okay, that is, we're not looking at extremely high levels of output or extremely low levels of output. Okay, but we're looking within like the 80%, where 80% of our production is going to fall and could easily fall. That's the point of analysis that we're going to be looking at. Okay. All right, you know what I'm going to do at this point, since we covered a lot in this chapter. At this point, I'm going to conclude, okay, for the day. And please, everybody, if you have not done so, please make sure that before we meet again on Tuesday, you read the rest of this chapter, okay, because it's a very significant chapter, a very important chapter. All right, and we are going to continue with the slide on Tuesday. Okay, you're welcome, Joshua. Everybody have a good weekend. Stay healthy, stay happy. Okay, COVID rates are really going up. Make sure that you exercise caution. Okay, and I will see you on Tuesday again. You're welcome, Kareem. More participation, Kareem. Have a good day. Thank you, Gerson, Manpreet. Christian, thank you. Jeffrey, very good.